And that's where we want to bring in our first guest, Marc Faber. He's an economist, market forecaster, as well as the editor of the Gloom Boom Doom Report, available at gloomboomdoom.com. Marc is joining us now from Hong Kong. Marc, thanks for being back on the show.
Thank you for having me.
So when we spoke mid-2019, you said, there's already some sectors that are going into recession. So you were concerned about the markets being overvalued relative to the economy. Shortly after we had spoken, the Fed started lowering interest rates. But now, coronavirus and all the fallout from that. How do you see this unraveling for, first of all, the U.S. economy?
Well, I think the U.S. economy and the global economy began to weaken about 18 months ago, and there was a slowdown, but the stock market kept on going up, especially after the October low, because the Fed began to inject liquidity, and its balance sheet was increasing, so that liquidity went into stocks and stock buybacks, and we went up until about February 19, and then we went down hard by, for many stocks, 50% in 1 month, for others maybe 30% in 1 month. But this is a major adjustment. It's falling off a cliff.
But Marc, first of all, forget the stock market for a minute. Economically, how do you think it'll affect the economy here in the United States? Mnuchin said, it could be as much as a 20% unemployment rate if Congress doesn't take action, putting us closer to a depression than a recession. Do you see that, or do you see this as ending up at the end of the day as garden variety type recession, but maybe having a bigger effect on the stock market?
No, we're falling off a cliff, and don't believe for a second officials who tell you, there is a possibility that we go into recession. We are in recession now. We are not in recession. It's a depression. Step out and walk through the street. Tell me how it looks like. In the depression, at least, you still could drink. There was prohibition, but everywhere there were speakeasies. Now everything is shut down.
So how long do you think we could go in economic stoppage due to all the isolation that we're all doing because of the coronavirus? How long do you think we can do that before things really, really elongate and get even worse? You think a 6 week stoppage? You think a 4-month stoppage? What can we weather versus what can we not weather, reasonably speaking?
Well, as you know, they have a fiscal stimulus in discussion of $1.2 trillion. I happen to think they will need $1.2 trillion every month. It's going to be very bad. I'm telling you, I've been in business for 50 years. I've never seen a situation where the economy just shut down.
Yeah, during the financial crisis, that was limited to the financial industry. And once the Fed got involved and helped that along, then it seemed like everything came back. This is truly a black swan event. And it's not a black swan event where there was a hurricane in Florida, an earthquake somewhere else, tornado in the middle of the country. It's national. So how far down do you think the stock market could go on this particular drubbing?
Well, it's like Grand Canyon. You go very deep when you walk down. And how low the stock market will go? Well, some stocks have already been hit very hard and may be in the process of bottoming. And also we're very oversold right now. So we may have a rebound of 20%. But I think, economically speaking, we're going down a valley. And the valley is U-shaped. In other words, we can't even see across the valley, and we need to be patient. We had an 11 years bull market. Do you think the bull market is all corrected in 3 months or 1 month?
Not at all.
It takes 2 years.
Exactly, and that's where, and I would agree. So you're saying 2 years where things really start coming around. Great. So do you think at the end of the day, from the peak of the market back in February, do you think that the market overall, let's say the S&P 500, will be down more than or less than 50%? What's your best educated guess?
I think the S&P will be down at least 50%, but 70% would not surprise me.
Okay. All right. I thought you might say
and
that.
I don't like it because I also own shares and I own bonds and so forth. But this is now a setback in markets that is brought about by deleveraging. And we have a credit implosion and everything is going down. Until recently, treasuries were rallying, but on the government intervention, they're now also selling off. They're 15% off the highs.
That's right. The treasury yields came up. Absolutely. Now, you mentioned a minute ago, almost as if it were a good thing, the extent to which the Fed had gotten involved. But I know you always have been, and when we spoke last June, you were kind of hypercritical of the Fed, saying they had gotten too much involved. They created this asset bubble. But do you think
Correct.
the actions the Fed took a week or so ago, at this point, do you think they were the proper actions? Are you in favor of that, or do you think they did too much or too little in this first phase?
I think that for years now, the Fed has essentially liquefied the system with QE1, QE2, and then Operation Twist, QE3, and since last August, essentially QE4 in the form of an intervention in the repo market. And I think the intervention in the repo market was not to help the man on the street, but to bail out some large hedge funds that may have had unfortunate positions. And I think that was all a mistake, and they're out of ammunition. In my view, certainly for the economy, they may here and there be able to boost asset prices again. But I think, again, the Fed's balance sheet would have to kind of double here to say $10 trillion.
But Mark, how about the most recent move where Fed funds rates got lowered to zero? And then on top of that, they said there's $700 billion of quantitative easing that we're going to be doing. How about that last move in light of the coronavirus crisis? Do you think that was the right move? Do you think it was too little or too much?
In my view, it is too much. And if you think clearly, we have a trigger, the coronavirus. The Fed's action will not solve the corona problem. You understand?
They're treating the symptom, not the problem, 100%.
Yes, so what they can do is solve some symptoms of the financial markets that were jittery. In other words, the market went down. But when you think about it, one of the problems of the recovery after 2008 is that as interest rates were kept low for a very long time, and because of QE, leverage built up and zombie companies were kept alive. The companies and countries that should have gone bust at that time.
So let me ask you this then, because it seems like, to me at least, like lowering the Fed funds rates to zero actually has a purpose, not just to stimulate the economy, but also keeping the financial system, the banking system, from getting all gunked up. But as far as the quantitative easing is concerned, I totally agree. That's not going to help the financial system from getting gunked up. And if people are too afraid and don't want to spend, they're not going to spend just because the government floods the economy with money. Am I missing something, or are you in agreement with that?
No, you're correct. If you are not allowed to go out, if your corner bar or pub is closed, you can't spend. And also, people don't realize small businessmen who, in America and elsewhere, the service economy is huge. In other words, around the financial centers and business centers everywhere, there are hairdresser shops, there are nail polishing shops, tattoo shops, massage parlors, and then All this is closing down with stay-at-home policies.
Last question. I asked you this 6 months ago. I asked you, do you think in the next recession we're going to go negative interest rates here in the U.S.? And you said, well, I'm really not sure. And now that the Fed's funds rate is officially at zero, now that we went sub 1 until just recently on the 10-year, and even the 30-year went below 1 for a couple of days. Now, do you think as this recession deepens, do you think we're going to go negative on interest rates here in the United States?
Well, I think it will be very difficult to drive the 30 years or the 10 years below zero because the Fed would have to come in and buy it all up. The market perception actually is quite skeptical of the intervention with fiscal measures because the deficit is already $1 trillion. Now you add another $1 trillion in fiscal stimulus. We're talking about $2 trillion, but this is minimum. You see, once they start sending out checks, $1,000 each in America, I think it will not be temporary, it will be permanent. They'll have to do it every month for the next 100 years. They'll go bankrupt before, but I'm just saying they're not going to be able to take it back.
So we need to leave it there for now, Marc. I really appreciate you being back on the show during these crazy, crazy times. And I couldn't think of a better guest. And I do have to confess that 9 months ago, when you told me on this very show that you thought that the Fed was going to start buying equities here in the U.S., I thought that was a little bit over the top. But with what's happened recently, I look back at that interview from 9 months ago and I say, you know what? I think Marc Faber was onto something. So we'll have to wait and see, and I look forward to having you back on the show again, Marc. Thank you.
Yes. Thank you.